You watch the stock grinding sideways for months after a devastating sell-off. Your charts show relentless chop, no clear direction. Most traders exit in frustration, convinced the opportunity has vanished. But here's what the Composite Man knows. This is precisely when institutional accumulation unfolds. While the public sees chaos in the trading range, professional operators are methodically absorbing every share the fearful release. The critical question is, can you decipher their footprints in price and volume before the markup campaign ignites? You've studied the charts for hours. The stock plunges without mercy, then suddenly reverses. It rallies sharply only to collapse again. Volume spikes erratically. Price action appears chaotic, random, a battleground of conflicting forces where you're consistently caught on the wrong side. Your stops get hit at precisely the worst moments. You buy the breakout, it fails. You sell in fear, then watch it rocket higher. The market seems designed to punish you specifically, but step back from the screen. Close your eyes for a moment. What if this apparent chaos is actually orchestrated? What if these violent shakeouts, false breakouts, and perfectly timed reversals aren't random at all, but rather the deliberate campaign of a singular intelligence working against your positions? This is the breakthrough insight that transformed my understanding of market operations, and it will transform yours. Imagine all the fluctuations in the market and in individual stocks as if they were the result of one man's operations. Let us call him the Composite Man. In theory, he sits behind the scenes and manipulates stocks to your disadvantage if you don't understand the game as he plays it, and to your great profit if you do understand it. The Composite Man represents the aggregated actions of today's major institutions, investment banks, hedge funds, pension plans, and algorithmic trading desks. He possesses superior capital, information, and positioning. His campaigns unfold over months, sometimes years. He carefully plans, executes, and concludes each operation before moving to the next. Here's how he operates in modern markets. The Composite Man attracts the public to buy a stock in which he has already accumulated a sizable position by creating the appearance of a broad market, making many transactions involving large share volumes. Today's high-frequency trading and dark pool operations amplify this effect. He advertises his stock through momentum, media attention, and algorithmic triggers that attract retail order flow. Your task is singular. Study individual stock charts with the purpose of judging the behavior of the stock and deciphering the motives of those large operators who dominate it. When you see price hammered down on expanding volume, then quickly recovered, that's the Composite Man absorbing panicked selling. When price pushes above resistance, then immediately reverses, that's him engineering a bull trap to distribute shares at elevated prices to break out buyers. With study and practice, you acquire the ability to interpret the motives behind the action that a chart portrays. This isn't mysticism, it's reading institutional footprints in price and volume. The Composite Man leaves evidence everywhere, in the volume patterns, in the price spreads, in the strategic placement of support and resistance tests. Once you understand his behavior, you identify trading and investment opportunities early enough to position alongside him, not against him. You stop being the victim and become the informed participant. You're no longer trading blind against superior forces. You're reading their campaign and profiting from it. This is the real game. Now you know the rules. The stock has been in freefall for months. Every rally gets crushed. Your portfolio shows devastating losses. Then comes the capitulation day, a massive down bar with volume exploding to levels you've never seen. The headlines scream disaster. Social media erupts in panic. Retail traders dump everything. The pain is unbearable, and every instinct screams, get out before it goes lower. You watch the intraday chart paralyzed as the losses mount with each tick downward. Then something peculiar happens. Price stops collapsing. Notice this carefully. Despite the tremendous selling pressure, despite the fear-driven volume, despite the bearish consensus, the stock refuses to make new lows. In fact, it closes well off the day's low. This is your first critical observation. Don't act yet. Simply observe. Over the following days and weeks, watch how price behaves. This is Phase A, the stopping action that halts the prior downtrend. Up to this point, supply has been dominant, sellers controlled everything. But now, the approaching diminution of supply reveals itself through specific, identifiable events that you must learn to recognize. First comes preliminary support, where substantial buying begins to provide pronounced support after the prolonged decline. You'll see this as volume increases and price spread widens, but the downward momentum starts to decelerate. This isn't random, this is the Composite Man beginning to take the other side of public panic. Then arrives the selling climax, the point where widening spread and selling pressure usually climaxes. Heavy or panicky selling by the public gets absorbed by larger professional interests at or near a bottom. In modern markets, this often coincides with algorithmic stop-loss cascades, margin liquidations, and ETF rebalancing, all of which create the perfect cover for institutional accumulation. Watch closely, the stock often closes well off the low in a selling climax, reflecting this professional buying. Because intense selling pressure has been relieved, an automatic rally typically ensues. This wave of buying comes from both institutional demand and short covering, the algos reverse. The momentum traders flip bullish. This rally helps define the upper boundary of your emerging trading range. Finally, price revisits the selling climax area in what we call a secondary test. Here's what you're looking for: volume and price spread should be significantly diminished as the market approaches support. If supply has truly been exhausted, this test occurs on lighter volume and narrower range. It's common to see multiple secondary tests, each one confirming that the Composite Man has successfully absorbed the available supply. The lows of the selling climax and secondary test, along with the high of the automatic rally. Now establish your trading range boundaries. Draw horizontal lines on your chart at these levels. You've just identified where institutional accumulation begins. The chaos has structure, the panic has purpose, and you're positioned to profit from it. The trading range has been grinding sideways for 3 months now. You identified Phase A perfectly. The selling climax, the automatic rally, the secondary test. You were certain the markup would begin, but instead the stock just churns. Up 1 week, down the next, your position is underwater again. The opportunity cost gnaws at you, other stocks are trending while yours oscillates endlessly. Doubt creeps in. Perhaps your analysis was wrong. Perhaps this isn't accumulation at all, but rather a dead stock going nowhere. The temptation to cut your position and move to something actually working becomes overwhelming. Stay with this. Do not abandon your position yet. What you're witnessing is the most critical phase of institutional accumulation and the one that defeats most retail traders precisely because it tests patience. This is Phase B, where the Composite Man is actively building his cause for the future markup campaign. In Wyckoffian analysis, Phase B serves the function of building a cause for a new uptrend. The horizontal accumulation you're seeing now will determine the vertical distance of the subsequent trend. Cause and effect, this is law number 2. During this phase, institutions and large professional interests are accumulating relatively low, priced inventory in anticipation of the next markup. But here's what most traders fail to understand: this process takes considerable time, sometimes 6 months, sometimes a full year or more. The Composite Man must systematically purchase shares at lower prices while simultaneously checking advances with short sales to prevent premature breakouts that would force him to pay higher prices for his remaining target position. Modern institutional accumulation happens through dark pools, algorithmic executions, and carefully timed block trades designed to minimize market impact. You won't see massive single purchases on level 2. Instead, you'll see the characteristic up and down price action of the trading range as professionals buy dips and sell rips. But critically, they're net buyers as the TR evolves. Watch the volume patterns closely. Early in Phase B, price swings tend to be wide and accompanied by high volume. The Composite Man is still battling public sentiment and competing interests. But as professionals systematically absorb the floating supply, something revealing happens. Volume on downswings within the TR tends to diminish. This is your key signal. When reactions show narrowing range and contracting volume, supply is being exhausted. You'll also observe multiple secondary tests during Phase B, along with upthrust-type actions at the upper boundary. These aren't failures, they're tests. The Composite Man continuously tests available supply at various price levels, gathering information about how much accumulation remains possible. Phase B requires discipline and conviction. You're not wrong, you're early. And early, when properly positioned, becomes right with time. You've held your position through months of sideways grinding. The accumulation structure looked perfect. Phase A identified, Phase B confirmed. Then, without warning, the stock breaks down. Price violates the trading range support, the very level established by the selling climax and secondary tests. Your stop-loss triggers. The chart screams breakdown. Technical analysts on social media declare the pattern failed. Momentum algorithms cascade selling. The stock appears headed for new lows, and you've just been stopped out at precisely the worst possible price. The frustration is crushing. You held through all that consolidation only to get flushed out at the bottom. But don't walk away from your screen. Watch what happens in the next few hours, the next few days. This is the moment that separates professionals from amateurs. What you're witnessing isn't a breakdown, it's a spring. This is Phase C, where the stock price goes through a decisive test of the remaining supply, allowing the Composite Man to ascertain whether the stock is ready to be marked up. A spring is a price move below the support level of the trading range, established back in Phases A and B, that quickly reverses and moves back into the range. This is the bear trap. The drop below support appears to signal resumption of the downtrend, triggering every technical breakdown alert, every algorithmic sell signal, every retail stop-loss order. In reality, this marks the beginning of the new uptrend, trapping late sellers who just handed their shares to professional operators at the absolute best prices. In modern markets, springs are engineered with surgical precision. Institutional trading desks know exactly where retail stops cluster below support. High-frequency algorithms probe these levels. Options market makers can see the put activity building. The Composite Man uses this information to execute the final shakeout, acquiring the last available shares at bargain prices before commencing the markup campaign. Here's your critical observation. A successful spring occurs on relatively low volume and reverses rapidly. If the breakdown were genuine, you'd see accelerating volume and continued weakness. Instead, you see a quick snapback, often within the same session or within 1 to 3 days. This price action reveals that no substantial supply exists below the range. The weak hands have been shaken out. The stock is now ready. Following the spring, watch for one or more tests of that spring low. A successful test makes a higher low on even lesser volume. This is your confirmation. When you see a low-volume spring followed by a low-volume test, you're witnessing the highest probability trade setup in the Wyckoff methodology. This is your moment. The spring isn't your enemy, it's your opportunity. The Composite Man just showed you his hand. The volume bar towers above all others, 3 times the average. Price drops sharply on this massive volume spike, penetrating support. Every technical indicator flashes red. The selling pressure appears overwhelming, undeniable. You interpret this as institutional distribution, confirming your bearish bias. But then Inexplicably, price reverses. By the close, the stock has recovered most of the decline, closing near the session high despite that enormous volume. Your short position is now underwater. The next day, price continues higher. You don't understand. Massive volume should drive price in the direction of the move, yet here it's doing the opposite. Nothing makes sense. Pause here. Take your eyes off the price bars and focus solely on what just occurred. You've just witnessed one of the most powerful signals in technical analysis, but you read it backwards. This is the foundation of Wyckoff's third law: effort versus result. Volume represents effort, price movement represents result. When these two elements harmonize, the trend continues. When they diverge, a turning point approaches. Professional identification of accumulation requires reading the relationship between effort and result with precision. When price drops on expanding volume but quickly recovers, when effort increases but result diminishes, professional operators are absorbing supply. That massive volume wasn't distribution, it was accumulation. The Composite Man stepped in front of the panic selling and absorbed every share the fearful public released. In modern markets, this principle operates across all time frames and instruments. High-frequency trading, algorithmic execution, and dark pool activity don't change the fundamental dynamic. They simply execute it faster. When you see price fall on expanding volume in a trading range reaction, then reverse sharply, institutional buying is occurring. The effort failed to produce the expected result because demand absorbed supply. The inverse reveals distribution. When rallies occur on increasing spread with relatively higher volume, this represents a sign of strength. Demand is dominant, price advances easily. But when huge volume accompanies a rally yet price barely moves, producing only marginal gains by the close, you're witnessing supply overwhelming demand. In a distribution trading range, this demonstrates the stock's inability to rally because substantial supply from large institutions is being released into public buying. Volume tells you WHO is winning the battle. When price declines fail despite high volume, institutions are buying. When price advances fail despite high volume, institutions are selling. This isn't about what retail traders are doing. Their volume is insignificant. This is about reading institutional footprints. Apply this analysis systematically. On every reaction in an accumulation range, ask, did the effort produce the expected result? On every rally in a distribution range, ask, did the volume create proportional price movement? These divergences reveal the Composite Man's true intentions. Now you're reading the market as professionals do, through the lens of supply and demand dynamics, not superficial price patterns. The setup looks perfect. The trading range has formed. You've identified the spring. Price is rallying off the lows. The sign of strength appears convincing. You enter the position with confidence, allocating significant capital. Then price stalls, it reverses. The rally was premature, just another test within phase B, not the final markup. Your stop gets hit. 2 weeks later, the stock finally breaks out and runs 40% without you. You had the right stock, the right analysis, but the wrong timing. The opportunity cost devastates you more than the loss itself. What did you miss? Before committing a single dollar to any position, stop. No matter how compelling the accumulation structure appears, no matter how obvious the spring seems, do not enter until you've verified every condition. This is where amateurs lose and professionals win, not in chart reading ability, but in disciplined execution. Wyckoff developed 9 specific buying tests precisely because he observed retail investors repeatedly entering accumulation ranges prematurely, then getting shaken out just before the markup campaign began. These 9 tests create a systematic filter that eliminates low probability trades and confirms when the line of least resistance truly favors upward movement. Test 1: has the downside price objective been accomplished? Use point and figure counting from the prior distribution range. If the decline hasn't exhausted the cause built during that distribution, further downside likely remains regardless of how attractive the current structure appears. Test 2. Do you see preliminary support, selling climax, automatic Riley, and secondary test? Without these phase A elements clearly present, you're not analyzing accumulation, you're guessing at a potential bottom. Modern algorithmic trading makes these events more violent, but doesn't eliminate them. Test 3. Is activity bullish? Volume must increase on rallies and diminish during reactions. If volume surges on declines and contracts on advances, supply still dominates regardless of what the price pattern suggests. Test 4. Has the downward stride been broken? The supply line or downtrend must be penetrated convincingly. In today's markets, watch how price responds after breaking the trend line. Does it hold above or immediately reverse back below? Tests 5 and 6 are higher lows and higher highs forming. This structural change indicates the character of the price action has shifted from bearish to bullish. One higher low means nothing. A pattern of them signals control has changed hands. Test 7. Is the stock stronger than the market? Compare relative performance during both rallies and reactions against the relevant index. Institutions concentrate capital in leading stocks. If your candidate underperforms during market rallies, professional money is flowing elsewhere. Test 8. Is a base forming with horizontal price movement? The cause is building. Sufficient horizontal accumulation must occur to justify the vertical markup you're anticipating. Test 9. Does the estimated upside profit potential exceed the risk by at least 3 to 1? Measure the point and figure count. Project the target. Place your stop below the spring or trading range low. If the mathematics don't favor 3 times reward to risk pass, all 9 must align. Not 7, not 8. All 9. This discipline protects your capital and ensures you enter only when probability overwhelmingly favors success. The stock breaks out from the accumulation range. Your entry was perfect. You caught the last point of support before the markup began. Price advances 15%, then 20% euphoria builds. But now what? How far will this move? Where do you take profits? Should you hold for more, or is the move exhausted? You have no objective framework for answering these questions. You hold too long, watching profits evaporate during the inevitable reaction, or you exit too early, banking modest gains while the stock doubles over the following months without you. Either way, the lack of a price objective leaves you trading emotionally, reactively, without professional discipline. Before the breakout even occurs, you need a target. Before you enter the position, you must know where it's going. This is Wyckoff's second law in action, cause and effect. The horizontal point and figure count within a trading range represents the cause, while the subsequent price movement represents the effect. This isn't mystical, it's mechanical. The amount of time and volatility that occurs during accumulation determines the potential magnitude of the markup. Large causes produce large effects. Small causes produce small effects. Here's the systematic process for modern application. Construct both a bar chart and a point and figure chart encompassing the same accumulation trading range and time frame. For the P&F chart, choose an appropriate box size based on the stock's price. Low-priced stocks under 50 might use a 0.5 to 1 point box size. High-priced stocks above 200 could use a 3 to 5 point box. The Nasdaq or S&P 500 index might require 50 to 100 point boxes. After identifying a sign of strength on the right side of the trading range on your bar chart, locate the last point of support, the low point of the reaction following that strength. Find this same level on your point and figure chart. Now count horizontally from right to left at the price level of the LPS. Take your most conservative count first, typically from the LPS back to the spring or final shakeout. As the trend progresses, you can extend your count further left, but do this in complete phases only. Never add partial phases. The first phase might count from the LPS to the spring. The second phase extends from the spring back to a clearly defined secondary test. Each phase represents a distinct period of accumulation activity visible on your bar chart through volume and price behavior. Multiply your horizontal count by the box size, then add this figure to the low of the trading range. This projects your minimum price objective. For more conservative targeting, also add the count to the halfway point between the range low and your count line. You now have multiple price objectives, minimum, mid-range, and maximum. In modern markets, these targets represent points where you should stop, look, and listen. Not exact reversal points, but zones where the Composite Man may begin distribution, where profit-taking occurs, where new consolidation forms. As price approaches your targets, tighten your trailing stops and observe the volume patterns. You're no longer guessing. You're trading with mathematical precision based on the cause built during accumulation. This is how professionals project targets and manage positions. You've now been exposed to a methodology that most retail traders will never encounter. The concepts are demanding: phase identification, supply and demand analysis, point and figure counting, the 9 buying tests. The discipline required seems overwhelming compared to the simplistic buy the breakout or follow the moving average strategies flooding social media. You might be thinking this is too complex, too time-consuming, too difficult to master while juggling the demands of modern life and rapid-fire market movements. Yet consider what you've actually learned here. You now understand that the market isn't random chaos, it's the orchestrated campaign of the Composite Man, the collective institutional intelligence that operates with superior capital, information, and positioning. Every violent shakeout, every false breakout, every perfectly timed reversal that previously seemed designed to punish you personally is actually the deliberate execution of accumulation and distribution campaigns. The Wyckoff Method provides you with a systematic framework to decode these operations. You can now identify when the downtrend truly stops in Phase A. You can recognize the cause building that occurs during Phase B's frustrating consolidation. You can interpret the spring in Phase C as opportunity rather than failure. You can read volume as the institutional footprint revealing who controls supply and demand. You can verify readiness through the 9 buying tests, and you can project price targets using point and figure counts based on the cause built during accumulation. This methodology has stood the test of time, not because it's easy, but because it reflects the real rules of the game as played by large interests. Richard Wyckoff dedicated his life to teaching the public these rules, so retail traders could stop being repeatedly fleeced and start trading in harmony with the smart money. Attaining proficiency requires considerable practice. You'll need to study hundreds of charts, identifying phases retrospectively before attempting real-time analysis. You'll make mistakes. You'll enter too early. You'll misidentify springs, but with each repetition, the patterns become clearer. The Composite Man's behavior becomes predictable. You're no longer trading blind. You're reading institutional footprints. You're positioning alongside the operators, not against them. You know when accumulation is complete and markup is imminent. This is your edge. Use it with discipline, patience, and unwavering conviction in the method. The game hasn't changed, but now you know how to play it.